Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. We bring to you each and every week some information, actually a lot of information about mortgages, about real estate, about what you need to do this spring. Yes, that's right. It is the spring buying season. And in order to really take advantage of the information that's out there about mortgages, about whether prices are going up and down, this is the show to listen to. KCAA brings it to you each and every week on a Saturday and Sunday basis. I really appreciate what they do and bringing the show to you, the information, everything else that we try to do. We're also on a number of different other social media. One of the main ways that you can get in touch with us is through our YouTube channel. Jeff Barton, the Mortgage Voice, is this show recorded with video, as well as my guest. You can also go to themortgagevoice.com as another place where you can not only see and hear, but you can also get in touch with guests on the show. So anyway, thank you very much again. This is Jeff Barton, and it is the Mortgage Voice. All right, so things happening in the mortgage industry. Well, we've seen some volatility in the rates. We've seen a little bit of reduction in the mortgage rates, the way they have over the past 2 months been going up. Well, we've seen probably the lowest rates that we've had in about 2 months in this last week. If the 30-year fixed rate mortgage is 6.6%, which it is on average across the U.S., that's pretty good. I mean, we've gone way above 7%. Like I say, in the last couple of months, certainly this year. So if we see this trend continue, but again, we've seen the zigzag before. We're up, we're down, we're down, we're up. So if you have a purchase that you're waiting to lock your rate, right now is a pretty good time. The 30 years, I said, is at 6.6%. The 15 years at 6%. Now, that's a really good rate, but you have to have the money with which you can afford to pay the monthly increase that you're going to secure if you do get a 15-year mortgage, although the rate is quite a bit less. 6.05 for FHA, 5.95 for the jumbo. Jumbos are back in vogue. I guess a lot more risk takers out there in the marketplace looking to get that kind of loan in the door. You know, if you're going to do a loan and you are a company that is out there trying to give you a mortgage, I guess there's more money in the larger mortgage size. There's also more risk. But at this rate, at 5.95, as is indicated this spring, we're seeing maybe some appetite for higher priced mortgages for lenders across the board. If you are one of these people who are in your area above $750,000 mortgage, you might want to check into a jumbo rather than some other kind of hybrid loan, just because those jumbo rates are pretty good. Check any number of different lenders out there and you can see. Rocket, Nations Direct, certainly there are obviously United Wholesale. All of these are lenders that would give you the best rate, especially if you are doing transactions with them on a multiple basis, meaning that you've had a mortgage with them currently and you go back to them and say, hey, I want to refi, or hey, I want to purchase something else. They'll probably give you the best rate. Credit score obviously is a big deal. Okay, so 6.60 is the 5-1 ARM. That's the other matrices that we look to. Let's see. Okay, so those particular rates that I'm quoting you were the rates for yesterday. Now, today the rates came out, and they're a little bit different, a little bit better. It shows that the appetite for bonds, the 10-year especially, is growing simply because we've seen some retrenchment in the inflation area, i.e. some of the matrices that we look at for inflation are coming down. We're going to find this Friday the unemployment figures, and what we've also seen as a prelim to that is that the number of job openings is down. We were quoting, for the longest time, over 10 million jobs available in the U.S., and that number seems to be shrinking quite a bit, which is right in line with the inflation numbers, which are also coming down. We may see inflation numbers for March in the high fives. in the low to medium fives, and all of those things are pretty good. So given that being what it is, bond market is selling with less of a yield, meaning it's going to cost you more to get less. And that's the way it works in U.S. debt. Obviously, if people are coming back to the U.S. debt as a safe harbor or as a place to go to make some money, that means more buyers. That means the cost will cost you a little bit more in the purchase, and you'll also get a little bit less in the yield. Okay, so today's rates on the 30-year, 6.37. For the 30-year, 5.81. For the 15, that's lower, a lot lower. 5.87 for the FHA, 5.96 for the jumbo, and 6.60 for the 5/1 ARM. Now the 2-year trading at 3.83. That's way off its really its highs, which is way above 4%, and the 10-year is at 3.341. You see the narrowing of the gap between those two. Now we've had the 2-year bond selling and the yield way above the 10-year for, it has to be close to a year, maybe a little bit more than that. We used to call that the inverted yield curve, but we don't even talk about that anymore because we're still looking for that supposed recession that's coming. I still think we're probably going to dip into one in the second or third quarter of this year as we see the numbers for inflation and the numbers for employment and the numbers for the number of jobs out there all change to the downside, which means that we have a slowing economy. It's what the Fed seems to want in terms of controlling inflation, as we see some of the things that OPEC is doing. OPEC has recently cut their barrels per day by 1 million barrels per day. This is going to send gas prices up in the U.S. this summer. I saw some quotes out there at $4 a gallon. Are we immune to this kind of up and down with gas prices? I mean, it seems to me we only hear about it during election season. It's awful. It's terrible. It's like a lot of things that go up and down in prices, especially when there is a market that says it's inflationary. Let's see, where was I the other day there was a price that went up that I was just, why is that price up? Oh, not used cars, rental cars. Now, I'm slow to the awareness that rental cars in certain markets during certain times, like what they call flex pricing, if you use Uber or Lyft, where if it's busy, prices go up, which I think is absolutely ridiculous. However, I understand it's a model to make money. In the rental car business, in order to get any car, mid-sized car, we just rented one. We're going to be up in Seattle in July, and it was like $200 a day. And I was like, no way, how can it be $200 a day? That's insane. I remember cars not that long ago. Well, maybe it was that pre-COVID car rentals that I was thinking about. You know, you could rent a car for $50. Now, the fees per day are also $50, so the actual rental is about $100 a day. But now it's double that, and I'm like, wow, this is unbelievable. The fees, the taxes, all that kind of stuff that gets included in this makes everything just so insane in terms of the pricing that, yeah, as you well know, as I well know, prices have gotten out of control. But again, I always go back to the demand, right? Is the demand or is the scarcity of the item that is in demand really the issue here, or is it just companies out there trying to raise prices easy and best they can? I think in an inflationary cycle like we're in right now, although we're winding it down somewhat, companies just use that as an excuse to raise prices, whether they're trying to ward off the expected downturn in the economy, or whether they're just greedy and wanting to get money. I have yet to see a company really explain why prices have gone up, other than to say, yeah, market changed, my supply chain is different, the costs are more, labor costs is more, which I do agree, labor costs have been more. A reason for that is obviously we have way too many workers way too few workers looking for many, many jobs. And as I said at the beginning, at the top of the show, that is going to change, and it has been changing. So, okay, we got a bunch of different things to talk about. Mohammed El Aran, who we talk about all the time, economist, I want to talk about the biggest mistakes made by the Fed, and two of them, I'll just run down it quickly. Two of them are, and we just talked about them. One is that inflation is transitory, right? And the other one is Fed tightening. Both of these things have been big mistakes by the Fed. They have either been slow to react to actual facts, or they have gone too far in terms of making it more difficult to borrow or more expensive to borrow, especially for banks who end up passing those costs on to you. I'm Jeff Barton. This is The Mortgage Voice. Really appreciate you listening in, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us, being a loyal audience out there who's looking for information about loans in the mortgage industry because you want to buy that house down the block. You can hear this show each and every week on KCAA, and they broadcast out into the Inland Empire, San Bernardino, Riverside counties, a little bit of LA, a little bit of Orange County, and certainly out in the Palm Springs area. We've been doing the show for about 8 or 9 years, and there are hundreds of shows that you can go to YouTube. Jeff Barton, the Mortgage Voice on YouTube. You can see this show as well as many, many others. You know, it's surprising. I do get comments quite often on shows we've done long time ago, and I don't know where these people are getting the shows, but the information tries to stay relevant. Certainly our next guest, Tomas Trujillo, can bring us up to speed on some of the products, and that always remains relevant. Tomas, how are you?
I'm doing great, Jeff. Thank you for letting me come on.
Thank you very much. Just tell us the lender that you work for and a little bit about that Cal Halfa program.
So I'm currently with FlexPoint Wholesale.
Okay.
And if you want the hot product, you want the product that is going to get you in now, it's our brand new Cal Halfa HFA 20% equity down payment. It is amazing. People are going crazy. They're losing their minds right now.
Okay, tell us what specifically. Okay, I want to lose my mind too, but I want to know what it is first.
Oh, it's a great program. So you come in, you need a minimum of a 660 FICO. Now, on top of that, there is a caveat to that. If you have a 680 FICO, it gets a whole lot easier. So let me go by it this way. If you have a 680 FICO, we will lend you 20% of the Fannie Mae high balance limit. So you'll get the high balance limit is $1,089,000.
Uh-huh.
We'll give you 20% of that for your down payment. You don't have to pay it back. You don't have to pay it back. Exactly. That's an amazing deal. Why would you want to use your money? Use the bank's money. The only rule you have here is you have to meet a certain income limit. You cannot make above a certain income limit. So for LA County, that's $180,000.
That's a lot of money.
Oh, that's a lot of money. I wish I made that much money.
I hear you. 180
Absolutely.
grand. Is that household or per individual? Is that per borrower, or how does that work?
That's per borrower on the loan. So if you're a husband and wife, that's both of you. If you're just a husband and the wife is not going to be the loan, then it's just him.
Okay.
100%.
So there's an income requirement. The bank, I mean, not the bank, but the state lends you who lends you the money? Who gives you the money, actually? The 20%?
State of California.
State
of California. Yes, sir.
And
they're ready to go.
This is all through Cal Halfa.
Yes, sir.
FHA.
All through Cal Halfa. Well, this one's going to be Fannie Mae.
Oh, okay. Oh, this is a Fannie Mae loan. Okay.
It's a Fannie Mae product, so it's a little easier right there, I think.
Right.
The other big deal about it is you have to be a first-time home buyer. No ifs, ands, or buts. You cannot have title. You cannot be on a loan anywhere for 3 years.
Okay, it's a 3-year requirement. Okay.
Yes, prior to 3 years, doesn't matter what you owned. But for the last 3 years, if you had no interest in a property, this loan is for you. The rate is smoking. The rate just went down to 6 1/8, 30-year fixed, no prepay. Amazing.
So you get the down. Okay. Now I'm going to ask some very obvious questions. How do you qualify for this?
You qualify as a regular Fannie Mae loan. It's a full doc, 2-year income deal, pay stubs, taxes, W-2s.
And this rate at 6 1/8? Is that what you said?
6 1/8 today, 6.125.
Okay, so you qualify at this rate for the 30-year. You get your 20% down given to you by Cal Halfa. Do you have to get a separate approval with them, or is it all just through one approval?
We take care of everything for you. You give us the application, we split it up, we underwrite it, we send it to Cal Halfa for their blessing, we draw docs, we fund it.
And this is only jumbo, Only
No. You
any
can
of
go
them.
from 100,000 all the way
Wow.
up to 1,089,000.
Okay, so
There's no limit.
and they haven't run out of money yet?
Not yet, but it's going to happen.
It's going to happen.
Absolutely
Okay,
going to happen.
so that's a good point. What is the limit or the amount of money that the state has to give away before they cry uncle?
They have $550 million to give.
Oh wow, that's a lot of money.
It's a lot of money, but there's a lot of people in California looking for homes.
So okay, so this is one of those deals where if you're out there and you're listening to the radio show right now, you're thinking, what? How is it exactly that this works? Okay, so it does work, but how do I get involved in it? What do they have to do? Give you a call? Call your mortgage broker?
First thing they do is they're going to call Jeff Barton at Malibu Funding and say, Jeff, I need you to get me into the loan. Jeff will you go ahead and he'll take your information down. You'll qualify the borrower. You'll get all his income, all his information, and the borrower is saying, but I don't have a property yet. And
right.
Jeff will say, you know what? I'm going to help you with that. He will either find you a property or he'll get somebody to find you a property. Meanwhile, you're getting your loan together. You're going to send it to me. I'm going to give you a pre-approval.
Right.
So I'm basically giving you a credit card and say, go shopping. You're approved.
Now, would this be also a TBD if they get a pre-approval from you that they're approved?
100%.
Maybe not 100%. Okay.
100%. Yes. I'll give you a TBD.
Wow, this is an amazing program. How long has this been around?
CalHAF has been around for a while now.
Right,
but
I
this
knew that.
program started last week. Last Monday is when it rolled out.
Oh my gosh, this is so. If you're out there and you're a first-time home buyer, right? Key, you're I guess just starting out, or you're somebody that's getting back into the market after a 3-year absence. This is a great program. The price really is 20% gift, which is not have to be repaid. Now, how does that work?
As soon as you sell your home,
right.
You're going to pay back. You sell your home or you refi your home, you're going to pay back the original 20% that you bought. So using easy numbers, if you bought a home for $100,000, CalHAF gave you $20,000. So let's say later on you're going to sell your home for $200,000. You're going to pay back the $20,000 you originally borrowed plus 20% of your equity.
Okay,
and
so
that's it. Now, if you're thinking, oh my God, my home is worth $1 million, now I'm not going to give you 20% of $1 million.
Right?
No, you're not. You're going to give me 2 times the amount that you originally borrowed. So
$40,000.
Give me the 20. Yes, sir.
Okay, so this eventually will be a pretty good deal for the state. I mean, it'll be spread out, and this income will be coming back. But obviously, going forward, it's going to be a great deal for the borrower.
Oh, how can you get into a house right now with free 20% down payment? That's amazing.
You can't do that.
Exactly. There's a perfect time to do it. Perfect.
Now,
you got Jeff who can help you, and it's amazing.
Well, now, what do you pay interest on? Do you pay interest on only the 80%, and the payback scheme that you just said is how that particular part works?
100%. So on your first loan, the 80%, you will not. All you're going to do is pay back the principal, PITI.
Okay.
You are not going to pay any MI. There is no MI on the first.
Okay.
So all you're doing is paying back the first. There's no payment on the second.
Okay. So and there's no interest on the second. So your interest is really only on the 80%.
Correct. And you're qualifying off the 80%.
Right.
You're not qualifying off the 100% of the loan amount. Only 80% because that's all you're borrowing. And you're not using MI. So it gives you more buying power right now.
Right, exactly. Especially in a market where, it looks like we're not seeing the bump in inventory that we normally see in the spring, so prices have actually started to rise again.
Right. So this is perfect. You get a little bit more for your money today.
Right, and with which you need that. Okay, so we're out in San Bernardino and Riverside counties. All of these counties are within the limit that we're talking about. Do you know what the county limit is out there? On the upper end?
You know what? We're going to follow Fannie Mae guidelines.
Okay.
Offhand, I don't have that information, but I can always look it up for you. It's not. We can always Google it, and they'll tell you exactly what it is. Okay.
People have questions. They're going to want to talk to the man. Give them your phone number and a way by which they can do that, if you would, please, Tomas.
Yes, sir. So you can always contact me at 323-228-5181, or give Jeff a call, and Jeff knows how to get a hold of me very easily.
Okay, excellent. Tomas, thank you very much. Really excellent. I'm glad we had you on. It was kind of a last-minute thing as everybody sees the excitement in my voice because this is a really, really good deal. Tomas, thanks very much for coming on the show.
Thanks, Jeff.
Thank you very much. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show, to listening to us, to listen to me talk about a lot of issues that may affect your decision, either mentally or actually in the cost of what it's going to cost you to either buy a house or to get out there and get a mortgage. The mortgage rates have come down some. That's very good news. We hope they actually drift down another half to 3/4 of a point. It might happen. It really depends on what's going on with the inflation, what goes on with the Fed, and a number of other things. Are you there, George?
Yes.
Okay, very good. I don't know what that was, but anyway, joining us, as everybody could hear, is George Gonzales, who is a loan officer for Malibu Funding. He joins us out from Rancho Cucamonga, out in the Inland Empire area, San Bernardino Riversides. George, how are you?
I'm doing great, Jeff. Thank you for asking, man. How's it going over there in Malibu?
Everything's going pretty good. Thank you very much. We talked a little bit off air about how we see some of the interest rates on mortgages coming down in the last 2 or 3 weeks. We've seen a downward trend. I hope this is something that's going to continue. What's your word on the street?
Well, the word on the street is, basically what's going on is we're on a 2-month low right now. This is the lowest they've been today, on a 2-month low. So, we're seeing a little more action. I'm getting some more phone calls. I'm getting some more buyers calling me saying, okay, George, is this time to buy, or, is it not, or whatever. And, my answer is always the same, Jeff. It's always a good time to buy, especially if you're renting right now. You're always going to need somewhere to live. So, whether you buy now and the market crashes, you still have a roof over your head.
Right.
And so I try to explain this to people to get their mind off of rates, which has been the big word the last few months. And it's starting to turn around a little bit because they're settling. I noticed the rates are kind of settling to where they're at for a while. So I'm seeing that people are, I guess, getting a little more comfortable, that they're not jumping up and down like they were.
Well, it's funny. I think historically we see time is the real benefit or not benefit of whatever the rates are. Like if you're used to a rate at a certain, like it's 6% for 6 months, then that's what the rate is. You don't think about what the rates were. This is the rate. So I think that is kind of also the thing that's settling in. And if we were at 7% a month ago, now we're down around 6%, maybe even a little bit lower. People are, more enticed, more incentivized to get out there and purchase something.
Yeah, that's correct. And what I try to do is I try to avoid saying what the interest rate is. When they ask me what the rate is, I just say, hey, how much rent are you paying, and what are you comfortable paying per month? And by that, it tells me, their story. So then I say, look, we don't even need to worry about the rate. I got that payment for you, and that's all you care about is the payment.
Yeah.
So that's been working out pretty good. And again, if the rates come back down, just like my past clients, you'll be the first one I ring to help you get your payment back, down a little bit more where you want it, more comfortable.
Yeah, I agree. Well, because we lived through that time period during COVID where rates were artificially held down because the Fed was flooding the market with cheap money and also cutting the short-term interest rate that they charged their member banks down to like a 1/4 point. I mean, so that is an unrealistic occurrence. That'll never happen again. And I think the sooner people really understand that, they can go about and say, okay, what is the actual monthly? Can I afford the monthly? How's my job looking? And, the standard things that people look at when rates are 5, 6, 7%.
Correct. And another thing they're noticing, you see a lot of people were thinking, since the rates are so high, the market's going to crash and we're going to get a house half off. Not happening, Jeff. It's, the most I've seen, a reduction so far across my area, the Inland Empire area, maybe 7 to 10% at max reductions. And, listings I'm seeing, okay, they're dropping them, but not what you expect.
Right.
I have a couple buyers right now who their mindset is, it's a buyer's market, so we're going to offer on a 450 house, we're going to offer 380, which you and I know that's not going to happen.
Nope.
But, and a lot of the buyers have the same mentality because of whatever they're hearing from whoever, and they're thinking that, we're going to get the best deal out there, which, no, I think I tell them again, you missed that train about 4 years ago, but.
Well, I think, the home prices themselves are going up. They're not going down. As a matter of fact, in 70% of the markets across the country that Case Shiller tracks, the prices have been going up 5% over last year. So it just tells you that the demand is so high and the inventory is so low that prices are just going to continue to rise.
Right. That's what I'm seeing over here as well. And again, the people that are on the fence are finally, getting a little more interested. Which, the way we do business, Jeff, you taught us well. Is we don't pressure people to get into a big decision. We show them their options, and we let them decide what's best for them and their families. Because at the end of the day, they're the ones making the payment, not me.
Right.
So I can't tell them it's a good deal, because it might be a good deal for me and a good deal for their neighbor, but it might not be a good deal for them. So, I just leave it on the table and I let them give me a ring once they're ready.
That's an excellent way, and I always like the lower pressure, because really choices to be made about somebody's financial future is not made lightly. And because people have, we talked about it earlier on the show, they're worried about inflation, they're worried about whether, they're going to be laid off if there's going to be a recession, they're worried about the war, they're worried about all kinds of different things that make their decisions harder. Presenting them with solid economic and financial information about the cost of the mortgage is really what we do. And most people appreciate that because it's a very low-pressure tactic.
Right. And exactly, you hit it on the nose. That's exactly what's going on. But, the good news is, like you said, is people are building confidence, because most of these people that I work with, they have steady incomes. They've been at their jobs very long time. They're professional. So I tell them, what are you waiting for? The only thing you need to worry about is if your job's secure, if you feel it's secure. And then, a couple excuses have been, well, I don't have the down payment, which brings me to another point. If you want to bring to that new program by Cal HAFA that was just introduced on the 27th of last month, which is the affordable home mortgage program, where you don't need a down payment. They're giving you 20% down. And so there's no excuses. So I'm calling these people back who are saying, we got to save for our down payment, and telling them, look, you don't need to save no more. As long as you're comfortable with the payment, move in. You don't need, no first and last. You don't need none of that. You're just going to move in.
Right.
And so that's been giving me some business I'm picking up. Thankful for this affordable home mortgage program that came back.
We had a lender on previous to your call talking exactly about that, it's Tomas Trujillo talking about, this program over at FlexPoint where he works. And I said, everybody's excited about this. The only problem is if the money runs out. So if you're out there and this is something that sounds like a good thing, give George a call.
Here's a rat race on that too, but here's the good news. What I found this morning, I was looking through the guidelines a little more stricter, and I seen that they are allowing you to go to a new build, and as long as you get in a contract, a professional contract of escrow, you can reserve the funds even if the house won't be built for 6 months out.
Oh, that's a great deal.
As long as you're in contract, that's the key. Being in contract, and then you don't have to lock your rate until you're 60 days within closing is when they tell you to lock the rate. But as you and I know, the Cal HAFA rates really don't move. They're pretty much in stone where they're at. So that's not even a problem. So that's a good news too, to tell anybody out there that if you're looking for a new build, you got 6 months, up to 6 months, you can reserve it and just make sure everything runs smoothly.
This is a great program, and really couldn't have come at a better time, a better time, just simply because people get discouraged, obviously with the prices now looking like it's going to continue to rise rather than fall as had been predicted, and this recession that was supposedly going to kill the housing market, it's still way off in the distance. So really, if the rates being what they are, which is as low as they've been in 2 months, as you said, this is a great time to get into a program like this.
Exactly. Again, and I tell people, do not worry, because once you're locked in, And if they do fall, that's what mortgage brokers are known for. Then we go to a bank where we can get you the rate that's right. We're not stuck with just working with one bank.
Right.
So, that's an advantage that I try to tell my fellow colleagues is, look, we have an advantage over direct retail bankers. Once they're locked, that's it. You're stuck. With us, we say, well, if you're not going to match the neighbor's rate, then we're going to go ahead and move the file over to Bank B because we have our client's interest in, first. And so that's, the benefit, obviously, with working with us mortgage brokers.
It's just excellent information, George. You want to tell people how they can get in touch with you, especially out there in the IE?
Yes, my direct cell phone number is 909-900-9565. My Instagram is at Home Loan Expert. George Gonzales, again, 909-900-9565. And I'm excited to help. Or actually, matter of fact, just answer any questions. You can pick my brain. Just give me a call, and, we can go from there.
George, thank you very much for coming on the show. Always a great bit of information that you give us. And this is a backup to that tremendous information we got earlier from a different interview. But this Cal Halfa program is a winner.
Yes, sir.
Okay. Thanks, George. Thanks very much for coming on the show.
Thanks, Jeff, for having me. Have a great day.
And you too. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. This show, we've had it on, 8-9 years now with Daryl. Probably, 400 or 500 shows? How many shows do we have?
400 easy.
Okay. So, needless to say, our archive of shows about information that has been going on for all these years through all these different situations. The current one is not a news situation for us. And if you want to go to these archives, Jeff Barton, The Mortgage Voice, not Jeff Barton, themortgagevoice.com or Jeff Barton, The Mortgage Voice on YouTube. Either one of these places are great places to find us, see what we're doing. Also, KCAA, which is the radio station that airs the show in the Inland Empire in Southern California, you can go there. They also have a number of archived shows, if not all of them. The people there, Fred and everybody over at KCAA, they've done a great job at providing to the public information that we have about loans, about how to help you get into the house that you want to get. Now, we earlier in the show have had some terrific guests talk about this new Cal Halfa program. Now, I know there are a number of other programs as well and a number of other scenarios that we can help you. To sort some of this out for us is Charles Giscombe from Malibu Funding, and he joins us now. Charles, how are you?
Great, Jeff. Thanks for having me again.
Thank you very much, and thanks for coming on. I appreciate it. I know that you're busy, which is a good thing because I know a lot of mortgage loan officers and businesses are not busy.
Correct. That is the nature of the business right now, Jeff. So I'm very blessed and happy to be working. Very much so. Malibu puts me in a situation to be able to do so. So thank you.
No problem at all. Okay, so some of the solutions that we offer not only entail what I had talked about with this Cal Halfa, but since you work not only here in California, but certainly in Nevada as the qualified employee out there, as well as a number of different places, what are some of the popular ways by which we can help those people who may have some difficulties getting approved by a normal conventional loan?
Jeff, it's a great question. The nature of the business right now in the industry, what we've been going through, has been very difficult. Obviously, interest rates are rising, banks are tightening up, and individuals just are fearful of what's going on in the media and what they're hearing about it. So what we have to do is we have to demystify that thinking process and create options and alternative loan opportunities for individuals. One of the things that's been helping us a great deal is non-QM loans.
Okay.
Obviously, non-qualified mortgages. We talked about this very many times, but they're becoming very prevalent in regards to where we are right now in the market. A lot of times, individuals may have the ability to repay the ATR. They just don't have the traditional structure. So a lot of times also, when they're doing their tax returns and different stuff, they're not showing enough income to show that they qualify. So what these non-QM loans do is they give people the ability to qualify through their bank statements, whether they're entrepreneurs, self-employed, whatever it may be. And now what happens with those bank statements is they qualify you based on the deposits and not based upon the bottom line number. So what your deposits are monthly will act as your income, which are normally 99% of the time going to be higher than what your tax returns state. That way, that particular lender will qualify you with that. In most cases, it immediately takes your debt-to-income ratio down to a number that is manageable and approvable by most banks. And in that case, that is your documentation. That is your financial income documentation that will allow you to qualify from that standpoint. And then they also have minimal FICO scores. You can get a loan done at 620, 640. Those FICO scores allow individuals to still get through the door. Once that happens, you can obviously you can get a deal done. You can get as high as a 90% LTV, and in a lot of cases, if your FICO score is a little bit lower, you can go down to 85 or 80%. There's still an opportunity and an option for you to get into a loan, still have a decent interest rate, and we also have some other key value-added services that we can add to those loans, so that make sure that your monthly check that you write on your mortgage is lower. They have options like 40-year interest only. Different things like that. There's no mortgage insurance on these. So your monthly check can be equivalent to a low interest rate traditional loan, but with less documentation. I think that that's a great way for individuals to get into the mortgage, the market, and still buy that dream home or buy that investment property, and know that they have a solid financial option to qualify for a loan.
I think the marketplace, the real estate marketplace, is not going to do what a lot of people thought, which was not crash, but certainly have a lot of what they're asking for in terms of the cost of the house is not going to get down. People aren't going to get the bargain they were looking for. And so what are you suggesting to people who are saying, hey, you know, what happened to this? Why is it right now prices continue to go up?
Well, what's happening is that when the crash occurred, there were some things that they did not expect. You know, there was, obviously we know when the crash happened, there were bad loans mixed with good loans.
Right.
And at the end of the day, the banks got really scared upon that. But there's been fail-safes put in play that won't allow that same situation to occur. Now, obviously, in the industry is cyclical. Interest rates will go up. It will correct itself. The market will correct itself all the time, so we expect that. But a lot of times people were looking at upside-down loans when the crash initially happened because the banks just had no idea. We have an idea now. And so now you can maintain the value. You can get in a property that's still going to be of value, won't be upside down, and therefore you'll be in the market. But don't expect a transaction to occur that's going to be where I'm going to get this house for a super steal.
Right.
That's not going to occur. It's not going to occur that you'll get that house for so below. You want the market to stay stabilized.
Yep.
You don't want it to be so high and inflated where you're having to bid against everybody else. But you do want that value to maintain itself, to maintain the integrity of its value, because it's super important for, just for the market, for the industry, and obviously so you can keep your money in your piggy bank, which is your home.
No, I agree with all that. I mean, I think the way that real estate is done and how the market is maintained its stability is based on what happened during the last crash and how the regulations that came in either through the CFPB or Dodd-Frank or both has really made the loan, the front end of the transaction, rather than the selling of the loans on the back end, really about making sure that there's an ability to repay, which is the ultimate thing that you want in every loan, and that the credit scores are, closer to 700 than not.
Absolutely, Jeff. You just said it right. That's the way they put those things in play. And those really are the major factors that will create comfort and warm and fuzzies for banks,
right,
lenders, and borrowers, obviously, and the sellers of homes. At the end of the day, as long as that can occur, we can have a functioning, healthy, robust market, even still with interest rates being as high as they are right now. And I tell people all the time, the interest rates will correct themselves. They may not go down to the all-time lows that we've been used to, but they will be at a manageable point, because at one time, before the last 6-year run that everyone had with all these low rates, we were used to be in the 6s and the 7s and 8s. This is nothing new.
Right.
This is nothing new. We have to realize that. And we can't let the media create a fear that makes us gun shy. We have to understand, as long as those values are there, in order for the market to correct itself, we have to keep recycling and utilizing the money.
I think all of that is true. I think the non-QM market, which is really taken over from subprime years and years ago, the reason that it's done so well is because not only are there good borrowers who don't want to use a traditional loan, but that a lot of borrowers out there who don't want to use traditional loans have great credit scores, who are used to paying bills. They just have businesses that they're running, and they have, as you said, bank statements which back up earnings for the company, but might not necessarily be the earnings that you're going to put on your taxes.
You're absolutely right, Jeff, because what happens is if you're a business person and you're really doing a lot of business, you have a lot of expenses, and you're writing many of these things off. And a good tax strategy is writing things off. Obviously, you don't get hit with that big tax bill. But what happens on bank statements and your deposits is those always tell you exactly what the real story is. You can see the money going into the account. It may not be the money that's there at the end, but it's the money that's in the account going into the account. It's an easy way for a lender to look at these bank statements, do an analysis, calculate what your monthly average is, and base your income off that. If you get 2 years of that, that can act as 2 years of a tax return and really let the bank have an idea and that underwriter understand who that borrower and who that client is and their ability to repay.
Right, and none of these loans are getting sold to Fannie and Freddie. This is the private mortgage system, which really is a protection that they didn't have during the last crash.
Absolutely. And I know more of the bigger banks are looking at these kind of deals right now because these are taking over the market, especially in where we are right now and the interest rates and where they are. So you really, if you aren't familiar with non-QM loans, you really should do some research, take a look at it. It's our job as loan officers and loan teachers to teach everyone, to do some research and find out what it is that you're looking for, what a non-QM can do for you, and why it will be beneficial to people in their structure.
Charles, thank you very much for coming on the show. Great information as always. I always enjoy our conversations. Thanks for coming on.
Jeff, thanks for having me as always.
Thank you very much. That's Charles Giscombe from Malibu Funding, Inc., and I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. If you want to catch our show, we have a number of great blogs that we're on, or podcasts, or any number of different things that you can, at your leisure, go and hear them. I think Daryl has a list of these podcasts. Daryl?
I sure do, Jeff.
Thank you.
We've got Apple Podcast, Google Podcast, Spotify, Spreaker, Stitcher, iHeartMedia, Odyssey, YouTube, podclips.io, and themortgagevoice.com.
Excellent. Thank you very much. I know that the radio station KCAA, who this show in the Inland Empire has been carrying the show since we really started, maybe 8-9 years ago. Excuse me for that. Really appreciate what they do. They bring a great signal to a wide area of the Inland Empire, San Bernardino, Riverside counties, as well as some parts of L.A., Orange County, and certainly out into the Palm Springs area, up to 15 and such. Really good people out there, and they bring this message to you. You can't get this information unless you research it, and you go to a lot of different places. We talk a lot about the macro, what's going on in the overall economy, what's going on in the overall scope and scheme of what makes decisions for you easier or harder, and then we bring some great guests on who talk about the micro of it, which are the programs themselves, what individual loans might work for you, and such. Today was no exception. We always appreciate those people that take time out of their day to come on the show and explain it all to you, and really explain it all to me. Again, I'm Jeff Barton. This is The Mortgage Voice. Okay, so let's get back to some of this other stuff that I've been talking about. There are 5 or 6 definite things that affect you as a borrower, and they affect you in ways that are both real and, mental ones, things that you think about. Like, for instance, if you're thinking about, I might lose my job, chances are you're probably not going to make a long-term financial purchase, meaning a mortgage on a house, or maybe even a car payment. Maybe you just hold off until you feel more secure about it. Some of the more real things in terms of what you look at on a daily are the actual rates that you pay. I mean, if you're going to get a loan on a house today, rather than 2-3 weeks ago, it's better because the rates are lower, so it's going to cost you less. It's going to cost you less up front. It's going to cost you less on a monthly. So these are real things that occur in everyone's life that really affect decisions, and decisions going to be made are really the things you have to think about when you're going to buy a house, whether you're going to refi, whether you're going to sell a house and try to buy something else. And these are the several things that I think are very important when you're considering, especially when you're thinking about how you're going to get through all these issues before you go out there and plop your money down and buy a house. Inflation, obviously inflation, as we have talked about for the last couple of years, is real. It's continuing to be real. And some of the things that are inflationary to you may be inconsequential to me, but certainly food, fuel, housing, all these things affect everybody. So if you're out there right now today and you're looking to buy a house and how you want to buy that house, inflation is the number one thing that you're probably going to think about. Recession, I just talked about it. If you're worried about whether you're going to have a job next week, yeah, that's that's a pretty important thing that you have to think about, especially if you're buying a house. Now, you're a person, you move to a new town, you're going to try out a new job, you're pretty excited, but is this the time that you want to plop your money down, as I said, or do you want to wait until you get some kind of seniority or whatever, maybe you have a contract, I don't know, but you want to make sure that that job is secure so that when you get that particular loan, that you're secure that you can make those payments for the next 360 months. I know nobody lasts that long, although I did, but nobody really goes that long without either refinancing, selling the house, or as such. Okay, the bank failures. Now, these bank failures have really receded. It's funny how things are so huge and hot one day, really disappear the next day, and nobody really talks about them anymore. Now, I don't know if you know who a guy named Jamie Dimon is. He's the head of Chase Manhattan Bank. Now, we've quoted him on the show many times. Love to have him on the show just to ask him a lot of questions about, the specifics of the bank and how the bank makes credit decisions. Credit decisions meaning how do they decide who's going to get a loan and how much it's going to cost? Is it really market-based conditions or is it you-based conditions? I think it's a bit of both, but it'd be great to have him on to ask. Anyway, what he says about what's going on slowly chips away at pandemic era savings. Okay, this is about you, the consumer, slowly chipping away at those pandemic era savings, which means you have been saving and had saved when all the checks came out. And by the way, Bernie Sanders trying to jam another one through, which I think is a huge mistake, inflationary and also maybe not needed. Okay, so maybe it is needed for a certain segment of the population, but overall, I think those kind of direct payouts are in the past, and then they should stay in the past. Anyway, this is what he says. It's the consumer slowly chips away at their pandemic savings, growing risk that the economy will be undercut by higher interest rates, chillier credit conditions, and persistent inflation. That's Jamie Dimon from Chase Manhattan Bank saying that. And what does he mean by, well, I talked a little bit about the interest rates, but certainly chillier credit conditions. This means that if we get into either an extended period of inflation, if we get into a recessionary period, if we see that there is other things that is worrying banks, like bank failures, you're going to find getting a loan for yourself is going to be harder because they're going to make credit restrictions tougher. Now, what does that mean? It means if they were giving you a loan at a credit score of 660, well, maybe they raise it to 680 or 700, which means that if you do have a 660 or a 680, it's either you can't get the loan or it's going to cost you more. Both of those things are not good things for you, the consumer, when we already have an affordability crisis out there. And by the way, we were looking for more inventory in the real estate market this spring. Well, guess what? It hasn't shown up yet. So whether you are aware of it or not, let's say 3 months ago, 70% of the markets in the country, of the 238 markets that are looked at by Kay Schuller, we saw that 70% of those markets were seeing declining prices. Now, we fast forward 3 months later, we're in the beginning of April. What is the status of those particular markets now? Only 30% are we seeing declines, meaning that 40% of those properties that were in decline are now not in decline. Matter of fact, we saw year-over-year gains of about 5.3% when we were seeing the other direction happen. And the reason is because we just don't have enough inventory. And the inventory that is available out there is increasing in value because of the scarcity. So those particular things, yeah. Okay, the next one, rate hike. Okay, so we see rate hikes go up and down, and what we're seeing right now with the Fed is that they keep raising their short-term interest rate. We may see another 25 basis point raise, although there is some sentiment to stop. Meaning we've seen bank failures, and one of the reasons the bank failures happened was because the Fed raised the borrowing rate, meaning that those banks that were positioned such that their long-term interests were tied to short-term interest rates. So if the cost of those short-term interest rates rose significantly, they were going to be short, and they just didn't have it. And when wind got what am I trying to say? When the customers caught wind of it, they rushed the bank and took their money out, and that's why certainly SVP. That's why they failed. Anyway, so let's move on. One more, Ukraine, a Russian war. Yeah, that's the thing that just drones on and on. Food costs, energy costs, those things are directly affecting you if you're trying to either decide on buying a car or, more importantly, getting a mortgage for a house. You want to make sure that the cost for gas doesn't continue to rise like it did, although we've seen a 53% decline in natural gas prices over the last 4 months. And the volatility in these markets mean that you cannot predict what your next winter home heating oil is going to be, or what your air conditioning costs are going to be this summer. And the last one is COVID. Yes, the dreaded COVID. Speaking of things that we constantly forget about when they were the biggest things that ever hit the market, COVID is one of them, and it's still affecting many people, not only here, but across the world, whether it's China's coming out of their particular lockdown or different areas of the world that are still affected by pandemic policies and pandemic worker shortage. All of these things are what they are. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Really appreciate you listening to the show, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.